We'll now have two back-to-back addresses, keynote addresses, in fact, about growing a fabulous economy in India, challenges, pitfalls, and opportunities. So put your hands together straight away for our esteemed speaker, Mr. Joep Beurden, the CEO of CSR Incorporated, having more than 15 years of experience in the US and Europe markets. Welcome to you, sir. It's straight away over to you.
Good afternoon. It's an honor to be addressing this Vision Summit, and thank you very much for having me. The semiconductor industry is a source of innovation, productivity, and growth. So growing a fabulous economy in India is indeed a massive opportunity for India, for the region, and for the world. So let me share some thoughts about the challenges, the pitfalls, and the opportunity of doing so. First, I would like to tell you a short tale of two very different but successful strategies. Then get a few words on the semiconductor industry as a whole, what is happening in that industry, before I get to the key of the argument, where I will argue that in order to be successfully creating such an ecosystem, you should be focusing on your strength and cooperate in areas where you're weak. I'll give you then a couple of live examples from CSR and from the Cambridge, the region where I live and work. Now, we all know this animal. It's a hare. And this hare is by all means a very successful animal. Its strategy for survival is really simple. It runs. And it runs very, very well. Some species of hare are able to run 64 kilometers per hour, 40 miles per hour. It can jump up to 3 meters, 10 feet, 15 times its own body height. So move over Usain Bolt. We all know this animal as well. It's a turtle. It's another extremely successful animal. It has been around for 220 million years, way longer than us humans. It's got a very simple strategy for survival. When it's in danger, it hides under its shell, and by the way, the shell also makes it stand out because we don't look like a rock. So why don't we adopt some of the turtle's strategy and start hiding or start carrying around a shield? Now, you can have a bit of fun with that, and everybody intuitively will immediately understand that both of these changes in strategy would be flawed. They're much better off focusing on the strength that they have that made them so successful in the first place. And it's interesting to see, if you go to the business world, how often you actually see behavior that I've just described. Whenever you see a company is late to a market trying to get in, whenever you see statements like regaining share or catching up, be aware, because it's typically a turtle getting rid of its shell, or it's a hare trying to protect itself, weighing it down. I'll come back to this, the lesson that it holds for us. Let me talk a bit about the semiconductor industry. Now, the first thing to know about the semiconductor industry, it's an industry of slow growth. Now, it's a bit counterintuitive because semiconductors are associated with fast growth. Well, it was fast growing from 1980 to 1995, about 20%. Then from 1995 to 2005, it grew 6%. And from 2005 to now, it's around 3%. So it's a slow-growing industry. It's about $320 billion in size. That is 0.5% of world GDP. But there is also some good news. There's estimates that the multiplication factor for every dollar spent on semiconductors is around 30, which means it's roughly 15% of world GDP. So the takeaway from this slide, it is an important driver of innovation and potentially of growth, but it's slowing. Drilling down a little bit further, within that industry, and I don't want to belabor this slide and go into all the detail, but if you run down the innovation nodes, in semiconductors it's all about the line width with which you produce your silicon chips. you go up, you go down in these nodes, and the cost increases exponentially. To the point that today, if you were to build a leading edge wafer fab at 22 nanometers or below, you're talking about an investment of around $6 billion. So slowing growth and increasing need for capital as you run down the process nodes. And this has commercial implications, because if you then say, look, every time I'm developing a chip, and you're doing the chip first in 90, then in 65, then in 45, then in 20, etc., the cost of investment and the cost of development of these chips is going up, which essentially means that the size of the market that you need to earn back that investment is going up. And this slide illustrates that. So it assumes that you have 3 competitors aiming at the market in a certain process node, and then calculates how big the market needs to be for these 3 entrants on that process node to be earning a return on investment. And as you come down the process nodes, you'll find fewer and fewer markets that will actually sustain you there, to the point that if you're at 22 nanometers, you have roughly 13 markets left. So we're talking about slowing growth, we're talking about higher cost, we're talking about fewer markets. So it's a pretty tough environment, actually. So the question then is, how do you win? And this slide is one of my favorite slides when you think about this question on how do you win. And it is an analysis, it's a bit dated by now, but I think it's still valid, that's looking at successful companies, large sample. You say, okay, the overall sample of hundreds of companies that have successfully grown over a period of about 5 years. And then there's high tech, there's telecom in the overall sample. And there's 3 main drivers for growth. The first one, and the most successful one, is so-called portfolio momentum. Essentially what it means is you have a certain differentiator, a certain strength. Think back to the hare and the turtle. And you leverage that strength in your portfolio. If you do that successfully, that's the largest source of growth, the largest source of success. The second bucket that you have is M&A, which is intuitive. Well, one, if you buy a company, of course, immediately you grow because you're typically buying revenue, but you're also usually buying another key strength, another key skill that you can leverage. And then the final one is, we're going to go out and gain market share. And the analysis here shows that if you go after market share, even if you win the market share, the price drop that you have to give away reduces all the profit to the point that you don't grow anymore. So, in other words, if you want to grow and you want to be successful, and this I hold is true for any market, go for portfolio momentum or M&A. Do not try to beat your competition with a Me Too product and gain share, because all that will happen is your profitability is going to go down.